We've been on this journey of demystifying derivatives market, and Kenya just became the second African country to adopt or to launch the derivatives exchange after South Africa. And it's quite a milestone for us. And in the last episode, we looked at a few products which are already in existence. For example, you can now trade, or you can now buy into an index portfolio, or you can buy a single asset a single asset exposure through the derivatives market. I just want us to move this conversation to specific key players in the derivatives exchange and how they are likely to benefit from this recent development. And let's start with the foreign investors who make up 70% of our daily turnover, 60 to 80% of our daily turnover. And welcome back, Jeff.
Thank you.
Is this going to be a game changer for the foreign investors who put so much money in this market?
I think one of the limitations we've had in really growing our foreign investor participation has been the issue around the size of quantity of stock they can buy.
Yes.
We have investors who have got a minimum ticket size whenever they want to buy a particular counter. A ticket size for one of the large investors could be something in the region of not spending less than say
$10-20 million.
$10-20 million.
Yes.
You can't get that in an underlying stock in one go.
In one go.
You can't. And so they get discouraged and they look for markets that can give them size.
Yes.
Now the derivatives contracts will be available and you can get whatever size you want.
Yes.
That then gives that new investor who believes in size to come in and trade in these markets. So it makes our markets naturally a very big market because of the leverage aspect of this contract.
I see.
So you're able to really get whatever size you want and take the kind of exposure you need. So that flexibility exists.
I see.
And that's what the value of this contract will do for foreigners.
So can they, let's take for example Safaricom.
Yes.
The daily float for Safaricom may be, let's say, $5 million.
Correct.
Can the derivatives market be several times of that daily float?
It can be several times of that daily float because basically we are taking the notional value of a contract. So for instance, Safaricom, we could say one Safaricom contract has a notional value of 1,000 Safaricom shares.
Yes.
So you can buy as many contracts to create or get to the number of the size you want.
I see.
So if it's 500 million of Safaricom, you just take 1,000 times, is it 500 or 50,000 contracts to get to the notional value that you want.
I see.
And get a similar exposure.
I see.
Okay? And then pay a percent of that as fees.
I see.
So that's what you're saying.
Yes.
It gives you that flexibility to leverage with the position you want.
I see.
And take a similar exposure. So that's going to attract the kind of investors we've been wanting in our market, but we've not been able to get them because of the float available. That's the key benefit I see it giving to the foreigners. Then the index contract gives a foreigner who wants to get a position of the market, maybe a foreigner who is basically investing in an index tracking market. That's their view. Their thesis is to invest in index trackers. They're able to get that through the 25 share index. So there's a lot of flexibility that we're opening up to a foreign investor to come and trade on our market. The ability also, because foreigners love markets that have got a certain level of volatility. So if they like to get volatility on our markets, they can do that through the contracts and not get the challenges of doing it on a spot market. And I think that's a key benefit that it offers to these kind of investors.
So one, it's going to scale up the market.
Scale up the market.
Two, it's going to give them more liquidity.
More liquidity. Yes.
And three, they're going to be able to trade in and out.
Quickly, yes.
Amazing.
And that's those are the key benefits we see.
Okay.
For foreigners.
Let's talk about local.
Yes.
institutional investors?
To the local institutional investors, and I like that question one because the local institutional investors are really, I've got more holding of the stock market as we speak. So you find they hold long positions or they invest for the long
Buy and hold.
View. Now, for these kind of investors, they have been suffering for a long time because the movement of these stocks, which they don't want to sell, is affecting them.
Yeah.
So every year the returns are not predictable.
Yeah.
So those long buy and hold investors will be able to buy the contracts that can protect the downside to their stocks through the derivatives market.
Yeah.
That's the key benefit that you see them enjoying.
Yeah.
The hedging opportunity,
Yeah.
the protecting opportunity.
Yeah.
That's what we see being the key benefit
I see.
for the institutional investors. Over and above the fact
Yeah.
that they can also trade
Yes.
and make some money.
Yes.
So other than if you have got, because some of them have got restricted limits.
Yes.
So I'm told that I cannot buy more than say 20%
Yes.
of a single stock. But I like the stock.
Yes.
Then let me go and buy the contract.
Yeah.
That's a new investment.
Yeah.
So I will only buy maybe a hedging one, but I also buy one that allows me to take a position on whether it's going to go up. So I'm capped on my Safaricom spot, but I'm then able to go and buy a contract because I still want to buy Safaricom or any other contract of that nature.
Yeah.
So that's the other opportunity that you see.
Yeah. Let's speak more about this. Most of the mandates that I've seen around, the institutional mandates that fund managers have, they actually restrict fund managers from participating in derivative instruments. Is that going to change, or what is the Nairobi Securities Exchange doing to overturn this situation so that they are not left behind by their foreign counterparts?
So what we've done as part of the building blocks towards setting up the market, we work closely with the Capital Markets Authority and the Retirement Benefits Authority to effect some changes in the investment allocation criteria for pension funds, for instance. So today, within what you call the schedule of investments that you can invest pension funds in, or the asset classes and the maximums that you can put, derivatives has been allowed as an asset class. You can actually invest up to 5% of the funds that you invest into the derivatives market. So that has been approved in the Retirement Benefits Authority's investment guidelines, regulations.
So stay tuned in, and this is an important market for you. It's a game changer, as Jeff said in one of the previous episodes. Thank you very much. This is Pius Mushiru Mugo, the Managing Director of Namo Capital, and you're watching Invest in Africa.